Good evening, my name is Alyssa Arsenault and I will be presenting a financial analysis for Finance 653 Spring 2018. The three industries that I picked for my financial analysis were the food retail industry, fitness industry, and alcohol industry. There will be 5 companies analyzed in each industry over 5 years. Each company will be analyzed individually and compared to one another. Based on the financial data collected, the best company in each industry and the overall best company will be chosen. To analyze each industry, I first retracted my data from Bloomberg and applied it to a spreadsheet where I could easily view each company's ratios and view them into a chart. After doing this, I created an industry average out of the 5 companies as a way to compare them. First, we will look at the food retail industry. The food retail industry as a whole has seen financial growth over the past 5 years due to the economy strengthening. The rise in income causes an increase in the demand for high-quality organic foods, which has led to an increase in revenue in that area. The financial growth can also be attributed to the technology changes, like the online grocery shopping trend and food consumption pattern changes. The negative impacts on sales are competition, online and non-traditional, interchange fees, cost of healthcare benefits, upward wage pressure, and then the state government regulations. The companies we will analyze are Whole Foods, Walmart, Target, Spartan-Nash, and Costco. To analyze the companies, the ROE was evaluated and then broken down in order to further analyze the driving factors. Further investigation was done to determine the best companies within the industry. Equity multiplier is showing industry leverage is consistent. In 2013, it seems the food retail industry became very efficient with assets, then declined after 2014 and is now on a more stable trend. Company value has fluctuated a bit but has shown gains in the past year. In early 2017, Amazon acquired Whole Foods for $13,768, which was more than their enterprise value previously. This purchase gave Amazon entry into the food retail and helped Whole Foods gain an online presence. In the short run, the company could stay afloat. All short-term solvency ratios were slightly above industry average. When looking at the long-term solvency of the Whole Foods ratios, the cash coverage and tier did not have values for 2013 through 15, but the equity multiplier had consistent small gains each year that is right below an industry average. Whole Foods asset efficiency is right around industry average and stayed pretty consistent, but there is no surprise for an organic upscale grocery store. They experienced slight declining returns on assets driven by the operating margin and profit margin. Interest burden also seemed to have an effect on ROE as well. After 2015, the ROE began declining after 2016 along with the ROA. The company's total value decreased every year since 2013 until they were acquired, and then went back up since Amazon bought them for so much more than their industry value. Compared to the other 5 companies, Whole Foods was taking on the least amount of debt to finance its assets. This indicated that Whole Foods was consistent but not innovating or growing. The low amount of debt and position in the market made them a good company for Amazon to acquire. Whole Foods was not the first to get into the e-commerce trend. Walmart acquired Jet.com in 2016. This was a smart decision for the company who relied on in-store purchases. When looking at the short-term solvency ratios, the company is below industry average on all ratios. Their current ratio is even under 1, meaning the net working capital is negative. In the long run, Walmart seems to be following industry averages. In 2016, the industry had a drop, which was reflected through Walmart's equity multiplier and tier ratio. Walmart is known as one of the leading companies in the industry, but their ROE has been on a consistent decline over the past 5 years, which is not consistent with industry averages. This is accompanied with declining enterprise value, although they still have the highest economic value overall, by far, and profit margins. Their future expected earnings relative to the past, based on price-earning ratio, positions them as an average company and assuming they will experience average growth. Walmart has relied on the low price standpoint, and during a time of economic growth, that strategy may not yield high revenue. The next company is Target. Target's short-term solvency ratios are similar to Walmart's and are also has a current ratio that falls below 1, meaning they also have negative net working capital. The cash and interest coverage ratios suggest that they are underinvesting and not borrowing at full capacity, which is necessary for future growth. Target's return on equity has fluctuated the last 5 years, but is the second highest of the 5 companies in 2016 and 17. Their total asset turnover is the lowest of all 5 companies, but they enjoy large profit margins and operating margins, which drives the return on equity. Target has also experienced declining enterprise value and price-earning ratio, giving us no evidence of strong future growth. SpartanNash is one of the least appealing of the 5 companies. Its short-term solvency ratios are close to industry average, but their long-term solvency ratios uncover the decline in the company with a negative cash coverage. SpartanNash holds the smallest enterprise value of the 5 companies and has the highest total asset turnover. They've experienced a decrease in return on equity over the past 3 years due to operational challenges. In 2017, ROE went negative, resulting from negative profit margin and operating margin. SpartanNash has the lowest market-to-book ratio of all 5 companies, but never reaches below 1. The severe underperformance is not reflecting future growth, making this company one of the least likely to be chosen. After analyzing the 5 companies, the most financially appealing company is Costco. It is the easier choice when searching for predictable growth and returns. Costco and Walmart are the largest retailers in competition for market share. Costco has double the returns of Walmart because of the membership-based model and some operational challenges that they have overcome. Costco did experience some short-term solvency ratio declines from 2015 to 2016, but has improved since 2016. Their cash coverage ratio is the largest of all 5 companies, suggesting that they are generating cash from operations for better than industry average. Costco had the highest market-to-book ratio, and it is continuing to increase. This suggests that managers are using assets efficiently because it takes less assets to create value for the firm. Costco had the highest ROE, and it was driven by profit margin and operating margin. Costco's ROE steadily increased the past 5 years, with one exception in 2016, where we see a slight drop caused by operational adjustments with credit card partner American Express. But then after 2016, Costco continued on its previous gaining in revenues along with their enterprise value that has continuously increased year after year. This shows that they are holding on to their market share and will not be affected in hard economic times. Costco's movement into the e-commerce shows signs of continued future growth. They partnered with Instacart last year to deliver fresh goods within 2 days. The transition is paying off with e-commerce sales up by 32.4%. Many of Costco's rivals are not holding up to Costco's increase in market share. Unlike many of Costco's rivals, they are all closing their brick and mortar locations and switching to e-commerce and focusing on e-commerce. But Costco is keeping their warehouses open and planning on using those as shipment points. The next industry analyzed is the fitness apparel industry. The fitness clothing industry has been a steady increase in sales since 2009. This is due to the health-conscious consumer trend and the social status behind it. Consumers will wear athletic, leisure clothing as everyday apparel, and it has become more versatile and accepted. With the increase in demand, there are more opportunities for companies to become oversaturated. The industry is much tougher. In order to remain profitable, they must stay up to date on consumer taste trends. The companies analyzed are Nike, Lululemon, Adidas, Gildan, and Under Armour. The fitness apparel industry averages were calculated from the 5 companies. In 2014, all companies experienced a jump in price earnings, showing industry growth. But it only lasted a year and went back to normal and has increased at a steady rate since then. Of the 5 companies, Nike is known as the safe, consistent company. It has been able to make it through multiple market cycles and has created a strong brand for itself. Its short-term solvency ratios have been consistent with industry average since 2014. Their long-term tier and cash coverage increase and are significantly higher than other companies until 2016, and then we see it decreases significantly. Return on equity have been steadily increasing and are high above industry average. This is driven by high operating margin, suggesting successful operating model that will result in sustainable returns. Although Nike has a relatively high ROE, their equity multiplier is also significantly higher than other industry average, which may be causing the above average ROE. Long-term growth for Nike is questionable due to a low price earnings ratio and the company showing signs of underinvesting. Unlike Nike's steady profit margin, Under Armour has been a one-hit wonder in the athletic apparel industry. Under Armour's short-term solvency ratios have steadily declined over the past 4 years, along with their cash coverage and tier ratio, which has been declining since 2013, but much more rapidly. Facing a decline in growth, they continue to have high total asset turnover compared to industry average. In 2017, they have gone into the negatives in ROE, profit margin, and economic value added. This comes as no surprise since their free cash flow has been negative for the past 3 years. Here is another fitness apparel company facing some declines. Gildan's short-term solvency ratios have been decreasing the past few years, except for current ratio, which has increased above industry average. This could be a sign that they're not using cash efficiently. The cash coverage ratio has decreased the past 3 years, meaning they are generating less cash from the operations. Gildan has shown above average growth in previous years, and its current price-earning ratio implies future growth. Annual revenues for Gildan are up to par with industry average, but the lack of earnings suggests that they may be not investing in future growth opportunities. They do not show any significant gains or losses, but they are below industry average in almost every aspect. The next company is Lululemon. Lululemon's short-term solvency ratios follow industry changes, but at a higher ratio value. All three short-term solvency ratios are significantly higher, especially the current ratio, which could mean they may have too much working capital. Lululemon does not show a tier or cash ratio for the past 5 years, but the equity multiplier is below industry average. Lululemon shows signs of future growth through their above average industry PE ratio. In Asia, they're experiencing triple-digit growth rates, giving them long-term opportunities. They're also enjoying a high return on equity that is driven by asset efficiency, and their online presence is performing above Nike's. The only concern is for the lack of diversity, which could be a disadvantage when it comes to larger companies like Adidas and Nike. Lululemon's market targets women and is specifically known for their yoga attire. This could also be why they are experiencing high growth at this time, because women's athletic clothing is on the rise. In the future, when the demand levels out, the narrow market for women's yoga apparel may not be enough to support the company. With all of that in mind, Lululemon may be a good company to acquire since they have opportunities for growth and no debt. Now, after analyzing the 5 companies, the most financially appealing is Adidas. Adidas is the old school athletic apparel company that is known for its soccer-focused product line. It has lasted through multiple cycles and continuously works on improving. Their short-term solvency ratios are lower than average, but are not low enough to raise any concern. As for the long-term solvency ratios, cash coverage and tier have steadily increased over the past 5 years, and equity multiplier has stayed consistent. Return on assets have been steady with industry average the past 5 years and can be expected to rise. This suggests that Adidas has found operating advantages based on EBIT margin and its driving forces over return on equity. Innovating to a more efficient operating system, the company plans to move more sales to e-commerce and removing unspecified amounts of brick-and-mortar locations. Compared to Nike, Adidas has more growth opportunities and better priced stock, making it the most attractive company in the fitness apparel industry. The last industry is the alcohol industry. This one was completed as a group, so since you will hear this 2 other times, I will try to make it a little quicker. The companies we analyzed were Samuel Adams, Constellation, Anheuser-Busch, Craft Brew Alliance, and Diageo. The alcohol industry experiences fluctuations. Currently, this industry is heavily influenced by millennials, which is a good sign for the future. Looking at the ratios, though, there are some concerns. The decline in asset efficiency and PE ratios are not good signs for industry growth. When we analyzed each of the 5 companies we selected in the alcohol industry, we determined that the Boston Beer Company was the best company to invest in. When we looked at short-term solvency ratios, we determined that Boston Beer Company had the strongest figures. Their current ratio increased from 2013 to 2015, but has declined each of the past 2 years. This is not a concern because their current ratio is still above 1, which is a sign of financial strength. 3 of the remaining 4 companies had current ratios over 1 for all 5 years. Constellation Brands, Craft Brew Alliance, and Diageo. In comparison, Anheuser-Busch has a current ratio that has been steady around 0.65, excluding last year when it was 1.07. This is a concern because they may have made too many promises to creditors. Where Boston Beer Company really separated themselves was in regards to their quick and cash ratio. Both of those ratios were significantly higher than all other companies in the alcohol industry. Boston Beer Company also had the lowest equity multiplier of all the companies in the industry. Additionally, their equity multiplier has decreased each of the past 5 years, signifying growing financial independence. The Craft Brew Alliance has comparable equity multipliers, but the remaining 3 companies have roughly double the equity multiplier. The key profitability ratio is return on equity, which combines return on assets, profit margin, and equity multiplier. Although Boston Beer Company only had the 3rd highest average ROE, I believe it is the strongest and most healthy of the 5 companies. Both Diageo and Constellation Brands had significantly higher ROE, but both companies had at least double Boston Beer equity multiplier, which is a technique companies use to boost their ROE. Boston Beer's ROE is driven by their superior asset management to all other companies in the industry, measured by ROA and solid profit margin. As far as market values are concerned, Boston Beer is trading a slightly higher PE ratio and market to book ratio than the industry average, which is a slight concern from an investor standpoint because it indicates an overpriced stock. However, it does show that there's plenty of confidence in the market for the future of the company. Furthermore, cash flows to shareholders has grown exponentially over the past 5 years for Boston Beer. In 2013, they had a negative 0.665 cash flow to shareholders, compared to this past year where their cash flow to shareholders was 102.96, which is a very good sign for investors because it shows that new equity is not being issued while dividends are also increasing. As you see here, Boston Beer Company is the most consistent in profitability. Diageo looks consistent, but its equity multiplier is significantly higher than industry average. The rest of the companies have intense fluctuations in ROE and do not have the PE ratio to suggest future growth, as does Boston Beer, which is why we chose them as the best. To conclude this financial analysis, let's review the companies chosen as best of their industry and choose a best overall company. All 3 industries go through constant changes. Between consumer preferences, economic fluctuations, and technology innovations, companies must stay current. The top company in each of the 3 industries are Costco, Adidas, and Boston Beer Company. These companies have displayed evidence of future growth and sustainability. Due to the beer industry's difficult trend, the best company overall would be between athletic apparel and food retail, since both of those industries are experiencing positive changes. The overall best is Costco. This is because of its promising future gains based on its previous successes. Costco is also taking a different approach to e-commerce and brick-and-mortar mixed structure. Instead of closing all brick-and-mortar, they're opening more warehouses. They also offer 2-day fresh grocery delivery and are still increasing e-commerce efforts. For these reasons, Costco is the best overall company.